Hello everyone, John AG here, and I need you to listen closely because something cracked in the US banking system this week, and almost nobody is treating it like the emergency it is. 3 nights ago, while most people were scrolling, sleeping, or arguing about headlines that don't matter, a regulatory report quietly hit a federal database. No breaking news banner, no urgent push notification, no polite call from your bank manager. Just a file, stamped with a time, sitting in plain sight like a tripwire. And inside that file was a number so ugly it should have set off alarms in every boardroom in the country. Losses big enough to swallow the bank's entire equity cushion, and then keep going. Now here's the part that makes this story dangerous. It isn't one bad bank. It's a pattern. It's a system-wide math problem. And if you've been told, relax, it's contained, I'm going to show you why that sentence is about to age terribly. Quick favor before we go deeper. I'm running a campaign to eliminate copycat channels that repackage this type of analysis. If you value original work, hit subscribe and comment OG John AG so I know you're with me. All right, back to the crack in the foundation. Late Tuesday night, a regional bank out of the Southeast filed its quarterly call report. On the surface, everything looked normal. Assets, deposits, ratios, the usual sanitized numbers. But deeper in the schedules, where almost nobody looks, was the real story. A line item tied to unrealized losses and a chunk of commercial real estate exposure that simply does not work at current prices. The figure was in the tens of billions, and when you compare it to the bank's equity capital, the message is brutal. If those losses were recognized today, the institution would be underwater. Negative net worth, insolvent in real economic terms, but it's still standing. Why? Because accounting rules give banks a magic trick. If they label certain assets held to maturity, they can pretend the market price doesn't matter, as long as they don't sell. The loss exists, but it's hidden behind a curtain. It's like saying, my house didn't drop in value because I refused to look at Zillow. That illusion works until it doesn't. And that brings us to the bigger point. The losses aren't just sitting in one report from one bank. They're spread across the entire banking sector, stacked on top of a commercial real estate problem that is moving from slow bleed to fast infection. Today is Friday, January 16th, 2026, and what I'm about to walk you through is not a conspiracy story. It's not doom for clicks. It's a chain of balance sheet math that has been building for roughly 3 years, speeding up over the last year, and is now approaching the moment where containment fails. If you add up the exposure, the unrealized hits, the refinancing wall, and the confidence problem that turns stress into a run, you land on a figure that is hard to say out loud: $8.5 trillion. And if that sounds like clickbait, here's the way I want you to think about it. In a banking crisis, there are 4 layers of damage, and people only talk about the first one. Layer 1 is the direct write-downs, the actual losses when loans default or get restructured, and when securities are sold below cost. That's the obvious part. Layer 2 is the forced support, FDIC resolutions, emergency liquidity lines, and whatever alphabet soup facility gets rolled out to stop the bleeding. That money doesn't appear from nowhere. It gets pulled from somewhere, or created, or guaranteed, and every option has a cost. Layer 3 is spillover, the investors and institutions that hold the same assets. Commercial mortgages don't just sit on bank books. They're packaged, sliced, insured, and distributed across pensions, insurers, REITs, and private credit funds. When valuations reset, the damage spreads sideways. Layer 4 is the economy itself. When banks stop lending, businesses stop expanding, construction stalls, hiring slows, and consumer stress rises. That's when a bank story becomes a recession story. When you combine those layers, the direct losses, the rescues, the spillover, and the economic hit, you can absolutely land in multi-trillion territory. That's why I'm using a number that sounds insane, because the system we built is insane. Trillions of dollars of assets priced off assumptions that no longer exist. And just to set expectations, you don't get to watch this play out calmly from the sidelines. Your bank app, your payroll, your credit line, your mortgage rate, your job market, those are all downstream of this. Now, one more thing before we move on, because this is where people get misled. You'll hear, if rates come down, the problem goes away. That is only half true. Yes, lower rates reduce bond losses and can make refinancing a little easier. But lower rates don't automatically refill buildings. They don't magically bring back pre-2020 office demand. They don't undo 3 years of leases expiring and tenants downsizing. And they don't fix the simple fact that many loans were written at valuations that were inflated by zero-rate financing. So even if rates ease, the damage can continue. That's the cliffhanger most people miss. The cycle can survive a rate cut and still break banks, because the collateral and cash flow are the real issue, not the value of all loans, not the size of the economy. The amount of capital and stability at risk if the dominoes start falling at the speed modern banking moves, digitally, instantly, emotionally. And yes, the next part matters. When this kind of cycle accelerates, it doesn't give you months like 2008 did. It gives you weekends. It gives you hours. It gives you a Friday night seizure and a Monday morning rebrand, while depositors refresh an app that won't load. So let's do what the headlines refuse to do. Let's map the problem, step by step, so you understand what's happening, why it's happening, and what the next catalysts look like. We've seen the first version of this movie already. On March 10th, 2023, Silicon Valley Bank collapsed. 2 days later, Signature collapsed. And the key lesson from that moment is this: you don't need bad loans to blow up a bank. You need a mismatch between assets and liabilities, and a loss that becomes real the second depositors demand their cash. Back then, the main trigger was securities. Banks loaded up on treasuries and mortgage-backed paper when rates were near zero. When policy rates jumped in the fastest hiking cycle in decades, those low-coupon bonds got crushed. On paper, the losses were unrealized. But the minute withdrawals forced sales, the losses became realized, visible, and fatal. That was the warning shot. Now the next wave is worse, because it's not primarily a bond duration problem. It's a commercial real estate problem. And commercial real estate, when it breaks, does not heal quickly. A bond still pays interest and eventually matures. An empty office tower doesn't magically refill itself because a spreadsheet says it should. Here's the difference in plain language. If a bank owns a government bond that dropped 25% in market value, it can still hold it, collect interest, and get par at maturity. The loss is painful, but it can be temporary, unless forced selling happens. But if a bank owns a loan against a building that's worth far less than the loan, and the tenant base is collapsing, and the borrower stops paying because the cash flow is gone, that is not temporary. That is a permanent impairment. The bank forecloses, takes the property, and discovers nobody wants it at anything close to the old price. That's where you get 40 cent on the dollar bids, and that is how capital disappears. Now, the story you're going to hear from a lot of places is commercial real estate is a problem, but it's manageable. The phrase manageable is doing a lot of heavy lifting there, because the stress is not evenly distributed. It's concentrated in regional and mid-sized banks that chased yield and used commercial real estate as their cash machine for years. And it's concentrated in specific property types, especially offices, older retail, and certain overbuilt segments of multifamily. Let's start with offices, because offices are the emotional heart of this crisis. Remote work didn't fade. Hybrid didn't normalize back to 5 days. The demand curve changed. And when demand changes, valuations don't politely adjust. They reset. Delinquencies on bank-held office loans have climbed dramatically from their pre-stress baseline. Even if you don't trust any single data vendor, the direction is consistent across the market. More borrowers behind, more buildings struggling, more loans rolling toward default as refinancing becomes impossible. And here's the key: delinquency is late. Delinquency is what you see after the fight is already lost. It means the borrower has been bleeding for months, trying to negotiate, trying to patch the hole, and finally failing. So when delinquencies rise, losses are not coming. Losses are already baked in. Now look at the scale. U.S. banks collectively hold trillions in commercial real estate exposure. Offices are a meaningful chunk, and a huge portion of office loans are now in negative equity, meaning the building is worth less than what's owed. That's when lenders discover the uncomfortable truth. Collateral is only comforting when it's liquid. An office building with empty floors is not liquid. It's a liability wearing a suit. Retail is next. Yes, there are great shopping centers. Yes, there are prime locations. But a massive slice of older retail is structurally impaired. E-commerce didn't pause. It permanently changed how much space is needed. Vacancy has risen, and many marginal properties are either being repurposed or simply dying. If you assume even a conservative impairment rate across that retail loan book, you're talking tens of billions in losses. Then there's multifamily. Multifamily was supposed to be the safe one. People always need somewhere to live, right? But multifamily isn't immune to the same forces that hit everything else: rates, supply, and affordability. Overbuilding in certain corridors created surplus. Rising financing costs changed the math for owners. Rent growth cooled, and pressures on consumers altered occupancy and collections in pockets of the market. Delinquencies in multifamily have risen. Maybe not as explosively as offices, but enough to matter when the totals are enormous. So if you take these segments together, office impairment, retail stress, multifamily pressure, you can build a conservative loss estimate that already runs into the hundreds of billions. Now add the other half of the pincer: securities losses. Banks still have massive unrealized losses sitting in their available for sale and held to maturity portfolios. Those losses shrink when rates fall. They expand when rates rise or stay higher for longer. And the point is not the exact dollar figure on any one quarter. The point is the vulnerability. A large share of banks are carrying assets marked far above what the market would pay today. That is a trap, because it turns a liquidity event into a solvency event. When depositors flee, banks must raise cash. When banks raise cash, they sell assets. When they sell assets, they lock in the losses they were not recognizing. And that is why the combination of commercial real estate plus securities losses is so lethal. One side erodes cash flow and collateral values. The other side weakens the bank's ability to meet withdrawals without destroying its own capital. But there's still a third piece, and this is the one most people aren't focusing on enough: the maturity wall. A tidal wave of commercial real estate loans is scheduled to mature in 2026. These are balloon structures, 5-year, 7-year, 10-year loans, written when money was cheap and valuations were inflated. When those loans come due, borrowers face 3 choices. 1, pay the full balance. Most can't. 2, refinance. But refinancing requires an appraisal that supports the new loan amount, and lenders now demand more equity, lower leverage, and higher debt service coverage. Meanwhile, properties are appraising lower because cap rates moved and demand weakened. That creates an equity gap. 3, default. Hand back the keys. Strategic default. And strategic default is not an if, it's already happening. It accelerates when borrowers realize the equity is gone, the refinance math doesn't work, and fighting just prolongs the pain. Here's what the maturity wall does. It forces a decision. It turns, we'll work it out, into pay up or walk away. And when you have hundreds of billions coming due inside a tight window, the system doesn't have the bandwidth to refinance everything, even if it wanted to. So defaults rise, losses get realized, capital gets hit. Now, at this point, a lot of people nod along and say, okay, there are losses. But they underestimate the thing that turns losses into a crisis: contagion. Banking is a confidence business. It runs on the belief that your money is there when you tap transfer. The moment that belief weakens, people don't calmly wait for quarterly earnings. They move money. We saw this in 2023. One failure created fear. Fear created withdrawals. Withdrawals created forced selling. Forced selling created visible losses. Visible losses created more fear. That loop is the doom spiral. And in 2026, the setup for a doom spiral is worse than in 2023 because the commercial real estate damage is now obvious. Office towers have already been repriced. Defaults are public. Buildings are trading at shocking discounts. It's not a rumor anymore. Now think about how depositors behave in that environment. If 2 or 3 regional banks get seized in the same weekend, depositors at similar banks won't wait for a press release. They'll do what people always do in a panic. They'll run toward what feels safest. That means deposit flight to the mega banks. And here's the cruel irony. Even if the mega banks remain stable, the act of fleeing makes the regional banks less stable. The withdrawals force asset sales. The sales realize losses. The losses weaken capital. The weaker capital spooks more depositors, and the cycle repeats. So this crisis isn't just about loan losses. It's about the speed of digital fear. Now let's zoom out and talk about risk concentration. Thousands of banks exist in the US, but not all banks are created equal. Many smaller and mid-sized institutions have commercial real estate exposures that are huge relative to their equity. Regulators have a threshold for high-risk concentration, and a meaningful number of banks sit above it. These are the institutions that can look perfectly fine on the surface, right up until the moment they don't. Because a bank doesn't need to lose half its asset book to fail. It needs to lose enough to wipe out equity. And equity is a small slice of the balance sheet. That's why a 10% loss on a concentrated portfolio can be catastrophic. Now, here's where the 8.5 trillion number comes in, and I want you to understand it the right way. When I say 8.5 trillion, I'm not saying banks will lose 8.5 trillion in loans. That's not how it works. The system has buffers, recoveries, restructurings, and bailouts. What I'm saying is, if you combine the direct losses, the rescue costs, the institutional spillover, and the economic damage from a credit freeze and recession, the total destruction of value and required support can reach into the multi-trillion range. Direct losses, commercial real estate impairments, plus securities losses, plus forced recognition from maturities. Rescue costs, FDIC resolutions, backstops, liquidity facilities, emergency guarantees. Institutional spillover, pension funds, insurers, REITs, CMBS holders, and other investors taking hits as valuations reset. Economic damage, Stalled lending, halted projects, layoffs, reduced spending, recession feedback. Add it all together, and you're not in a few bank failures. You're in systemic stress. And the uncomfortable truth is that the FDIC is not built to absorb a wave. The Deposit Insurance Fund sounds massive until you compare it to deposits. It's a small pool relative to the ocean it promises to protect. In normal times, that's fine, because failures are isolated and the fund replenishes. In a cluster of failures, the math becomes political very quickly, which is why, when push comes to shove, the backstop becomes the Treasury and the central bank. And that means money creation, and that means inflationary pressure, even if it's delayed. Now, before we walk the timeline forward, check the description after this video. There are bonus links there, including the premium WhatsApp channel and a channel membership link. If you want the deeper breakdowns and updates as this evolves, those links matter. All right, let's talk about the next 6 months, because this is the part that determines whether you get caught reacting or you get ahead of it. Phase 1. The office reset goes from sector story to headline event. In the next several weeks, you'll see high-profile office properties in major cities hit the market at prices that look like typos. Towers that were valued in the billions will trade at fractions of that. And each trade prints a new comparable sale that forces appraisers to mark down similar buildings. That is how the valuation spiral accelerates. Banks don't need every building to default. They need a pricing regime that forces recognition of lower collateral values and tighter refinancing terms. And that's what these sales trigger. Phase 2. The first weekend of seizures. At some point this spring, a Friday night announcement will hit. One or more regional banks closed, depositors transferred, operations resumed under a new owner or bridge bank. The press release will use calm language: unsafe and unsound practices, insufficient capital, orderly resolution. But the market will read what it really means. Losses got too big to hide. And when that happens, it won't just hit those banks. It will hit every bank that looks like them. Here's what that weekend looks like in real life. Friday, after the close, a short statement drops. People who don't follow finance won't even see it until Saturday morning, when screenshots start spreading. By Saturday afternoon, group chats light up with the same message. Is this our bank? By Sunday, the nervous depositors are already logged in, planning transfers for the second the system allows it. Then Monday hits. If the failed bank is reopened under a new owner, most customers are fine, eventually. But eventually can include a frozen debit card for a day, a payroll batch that doesn't settle, or an online portal that shows the wrong balance while systems migrate. In a normal week, that's an annoyance. In a stressed week, that's the spark that pushes people to move money preemptively. And once a move starts, the banks left behind face the worst kind of funding problem: a silent run. Not lines outside a branch, just millions of taps on transfer, bleeding deposits out in minutes. Now, I'm not saying this to scare you into stuffing cash in a wall. I'm saying it because you should understand the new speed of panic. Banking used to move at walking pace. Now it moves at Wi-Fi speed. And if you're wondering, how do I know if my bank is vulnerable before the headlines? The answer is painfully simple: concentration and capital. A diversified bank with a thick equity buffer can take punches. A concentrated bank with thin capital can't. If commercial real estate loans are several times larger than equity, one bad year can erase the whole cushion. That's why I keep talking about ratios. It's not about predicting the exact default rate. It's about knowing whether your bank has room to absorb surprises. This is also why I want your real-world input. If you work at a bank, in commercial lending, in property management, or in construction, you're seeing the stress before the public does. Without revealing anything sensitive, tell us what you're noticing. Are borrowers asking for extensions? Are lenders tightening terms? Are appraisals coming in way lower than expected? Your comments help everyone understand the reality behind the headlines. Phase 3. The maturity wall bites. As the year moves into the heavy refinancing window, borrowers who assumed rates will be lower by then are going to run into reality. Even if rates drift down slightly, the spread environment, underwriting standards, and property cash flows can still make refinancing impossible at the old balances. So you'll see a wave of extensions, modifications, and then defaults when negotiations fail. And each default forces a bank to classify the loan, increase reserves, or take a write-down. Phase 4. The deposit insurance anxiety moment. This is where the public narrative shifts from "some banks failed" to "is the backstop enough?" A single failure doesn't scare people. A cluster does. And when the fund drawdowns become a topic, the confidence game changes. Officials will reassure, markets will still question, and that tension pushes depositors toward safety, which ironically pressures the very institutions that need deposits to survive. Phase 5. The new facility. If the stress becomes wide enough, expect a new liquidity or purchase program with a harmless name. Something like stabilization, transition, support. The mechanism will be the same as always. Accept troubled collateral, lend against it, or buy it at prices higher than the market would pay to prevent forced recognition and cascade failures. That's a backdoor bailout. It's not free. It moves the risk. Phase 6. Zombification. This is the phase that doesn't make dramatic headlines every day, but does long-term damage. Banks that survive become cautious. They stop lending aggressively. They hoard capital. They turn conservative. That means fewer loans, fewer projects, less growth. And when credit creation slows, the economy slows. Now, if you want a historical parallel, look at Japan's lost decade dynamics, or the slow, post-crisis grind after 2008. The acute panic can be short. The sluggish recovery can be long. And here's the cliffhanger you need to consider. Even if the government stops the panic, it may not stop the damage. Because you can print liquidity, but you can't print tenants into empty buildings. You can backstop deposits, but you can't backstop the cash flow that made those loans work. You can delay recognition, but you can't permanently avoid reality. And the longer reality is delayed, the longer the economy pays for it. Now, what does this mean for you? Practical steps, no drama. First, understand insurance limits. If you have more than $250,000 at a single bank in the same ownership category, the amount above that limit is not insured in the standard way. During calm periods, people ignore that. During a bank stress period, that becomes a serious risk management question. Even if authorities decide to protect uninsured deposits in a specific crisis, that decision is discretionary. It's political. It's not guaranteed for every failure. So if you're sitting on large balances, don't wait for a headline to learn what the rules really mean. Second, don't assume access is instant. Even insured depositors can experience short disruptions when a bank is resolved. Systems switch, cards pause, online portals glitch. Usually it's brief, but brief is still painful if it hits at the wrong time. Having a modest cash buffer for essentials is not paranoia. It's basic redundancy. Third, know your bank's exposure. You don't need to be a professional to do this. The call reports are public. The schedules show commercial real estate categories and equity capital. The ratio between the two tells you whether your bank is heavily concentrated. If the ratio is high, your bank is more sensitive to CRE losses. Fourth, business owners, listen. If payroll depends on one bank, you're vulnerable. If your operating cash sits in one place, you're vulnerable. Have a second relationship. Have the ability to move funds quickly. Don't assume you'll do it later. Later is exactly when systems are crowded. Fifth, if you own commercial property with a maturity coming up, start early. The refinance market is a queue. When everyone hits the same maturity window, lenders pick the best borrowers and the best assets first. Waiting compresses your options. Start negotiations and contingency planning now. Sixth, investors. Be careful where you're exposed. If you're holding instruments tied to commercial real estate cash flows, understand what a valuation reset does. Dividends can be cut, debt can be restructured, securities can reprice violently when defaults rise and refinancing freezes. You don't want to discover your risk profile after liquidity dries up. Now, I also want to hear from you, because the smartest insights on this channel often come from people living it. If you've navigated a refinancing negotiation, a bank merger, or a commercial property sale in this environment, share your experience in the comments. What did you see and what surprised you? And here's a second question. Do you think the first real trigger will be an office default headline or a regional bank seizure weekend? Tell me which catalyst you think hits first and why. Also, friendly reminder, if you're successful right now, even outside real estate, share a quick win in the comments. It helps other viewers keep their morale up when the news cycle is heavy. Now, let's connect the dots to the bigger system, because this isn't isolated. For over a decade, the global economy was built on cheap money, rates near zero, central banks expanding balance sheets, liquidity everywhere, asset prices inflated, real estate prices inflated. The world treated low rates like gravity. Then rates moved. And when rates move, the price of everything that was financed cheaply must adjust. Stocks, bonds, real estate, venture, private credit. It's sequential. The stress travels. First you saw tech and duration assets shake. Then you saw specific banks crack. Now you're seeing commercial real estate reveal the cost of the last cycle. And here's the part I want you to keep in mind as a cliffhanger for what comes next. The banking system is the transmission belt. When banks get cautious, credit tightens. When credit tightens, small and mid-sized businesses feel it. When businesses feel it, hiring slows. When hiring slows, consumers slow. When consumers slow, defaults rise. and those defaults feed back into banks. That is how a property problem becomes an economy problem. Now, I'm not telling you to panic. I'm telling you to pay attention. Because the most dangerous moment in a financial cycle is not when everyone is screaming. It's when the cracks are visible, but the crowd is still pretending it's fine. The quiet phase is when you position. And positioning doesn't mean making wild bets. It means being thoughtful. Where is your cash? How diversified are your exposures? How resilient is your personal system if a bank you use gets disrupted? If you do nothing, you're choosing to rely on officials acting perfectly under stress. Sometimes they do, sometimes they don't. Sometimes they act, but not fast enough for your personal timeline. Now, I promised you a map of the months ahead, but I also want to give you one more layer, the psychological game. When the first major bank shows a massive hidden loss in a report, people shrug, until the second one does. Then the third. Then someone starts asking, how many are like this? And that question is the match. Because depositors don't have time to audit every bank. They make a simple decision. Move to the place that feels safest. That movement itself becomes the event. So the most important variable here is not just default rates or cap rates, it's confidence. And confidence can change in a day. That's why I said earlier, this will not necessarily feel like a slow movie. It can feel like a switch flips. Now here's another quick plug that matters. We're also offering members-only videos. Deep research, separate team, more sourcing, more frequent updates, built specifically for premium members who want the higher resolution picture. If that's you, check the membership link in the description. And one more creative note while you're down there. If you want silver-related success stories, there's a link in the description to a separate channel that focuses on how people have actually made money around silver. Subscribe there too and binge a few stories. Some of them are wild. Okay, let's land this plane with the core message. A bank can look healthy while it's hiding losses. A banking system can look stable while stress accumulates. And a market can look calm right before the moment it isn't. The call report that dropped this week was not the crisis. It was evidence of the crisis. A flashlight beam into the closet. And if one sizable regional bank can show losses that overwhelm its equity cushion, you should assume more exist. Because the same conditions produce them. Low-rate assets bought at the wrong time, commercial real estate underwritten under outdated assumptions, and a refinancing calendar that is forcing reality into the open. So what do? You don't ignore it. You don't doom scroll it. You manage your exposure. You diversify your banking relationships if needed. You understand insurance rules. You keep modest liquidity redundancy. You plan for disruptions. And you keep learning, because the people who do best in chaotic cycles are the people who see the trend before it becomes consensus. One last practical move. Build redundancy before you need it. If your savings sits in one institution, open a second account elsewhere and test a transfer while everything is calm. If you hold large balances for a business, ask about sweep programs or insured cash solutions and confirm the fine print. Also remember, a money market fund is not automatically FDIC insurance. Know what you own, know who guarantees it, and know how fast you can access it on a bad weekend. Because the first real signal won't be a headline. It'll be an app outage, a delayed wire, or a rumor that spreads faster than facts. Preparation is boring until the day it pays you back. Do the boring steps before it's urgent. If you want me to keep tracking this and breaking it down in plain English, do two things. Hit subscribe and drop OG John AG in the comments to support the campaign against copycats. And for everyone watching who hasn't subscribed yet, don't be the person who shows up after the storm already hit. Join the channel now so you don't miss the next update, because the next filing, the next seizure, or the next default headline could happen faster than people expect. Check the bonus links in the description, premium WhatsApp channel, membership, and more. Take care of yourself, take care of your family, and I'll see you in the next one.